Is it recession avoided or simply just delayed?
Good morning, Jonathan. You may recall our conversation much earlier this year when I had said that the last time so many influential people said something was going to be as great as this bond market was expected to be was the Firefest. And I think that's exactly what we've seen. And our view had been earlier this year that the economy will prove to be stronger than what was being priced in, that Fed cuts were not going to materialize to the aggressive extent that was being priced in. And that's exactly what we've seen so far this year. So, of course, now the calls for recession this year have been pushed out, as they have been really for much of the year, by a few months. But I think what's much more important than the sort of inflationista versus recessionista battle of this year is really if we pick up our eyes and look a little bit farther out to the horizon and see that this fiscal spending that's certainly, contributing to this move in yields, along with a number of other factors for sure, but that this fiscal spending is not likely to stop, that the demands in the public purse are going to continue long term, and they're going to continue stoking, long-run higher inflation. That doesn't mean we're going to go into any kind of an inflation spiral, but it does mean there will be more volatility to interest rates, to the bond markets, and that the last decade is nothing like what the next decade is going to be like for fixed income investors.
From your standpoint, where is that risk? Is it in credit or is it in sovereigns at the moment?
It is really both, because there is no impetus, again, for the Fed to really do anything here. You have a strong economy, you have strong housing, you have low labor, unemployment, essentially. And so there's really nothing to point to say that, look, this is recession right here, or this is weakness right here, or this is why the Fed needs to cut right now. And without Fed cuts, we're going to see this market try to stand on its own, which means it will have to reprice to the longer-term expectations for higher growth and some of these other issues around fiscal spending, as well as the fact that the other two huge anchors, the ECB and the BOJ, are also normalizing their policy, pushing rates higher. So I think interest rates will continue to be a risk for sure, and we're likely not done here. This bear steepener may have some more room to run, but the credit cycle is also underway for sure, right? We saw the bankruptcy of Yellow this morning, and that's just one of a string of bankruptcies that has continued to be kind of a steady drumbeat against the backdrop of this stronger economy. The lower-rated credit companies are certainly beginning to struggle. We've seen the default rate triple, albeit from incredibly low levels in the beginning of this year. But the credit cycle is underway, and we think that the credit repricing, the corporate credit repricing, will happen, frankly, irrespective of whether you see a broader recession or not, simply because these lower-rated borrowers are going to really struggle to find cheap financing in this higher rate world. And I think that will open up very attractive opportunities for credit investors. We've seen even since the beginning of this year, the very weakest part of the high yield market, the triple Cs, have jumped, very significantly in their spreads compared to some of the better quality names in that part of the market. So you do see kind of the weakest leading in terms of that spread widening. We haven't seen that spread widening anywhere else in the market yet, but we do believe it's coming. For investors who have liquidity, there will be a really great opportunity out there in the next 6 to 12 months.
The CPI on Thursday, PPI on Friday. Oksana, Jim Bianco of Bianco Research has said he thinks inflation is bottoming out for the year. He doesn't think from here that you're going to see a continued deceleration. What you'll see, to what Keith just said, is inflation picking up again into year end. Are you sensing the same thing?
I definitely think that that's a very distinct risk, and we are seeing, of course, energy prices perk back up, where there's a lot of questions around other commodity prices given the war in Ukraine and the wheat prices. But there's also kind of, John, a perfect storm around, to the extent that we are talking about interest rate levels, right? And that's why we're talking about inflation. It's the cost of capital, which of course impacts everything. There is kind of that perfect storm in the works right now, and inflation is just one of the moving parts. You've had this higher than expected amount of treasuries at auction, or the Treasury is going to need to borrow. You've had BOJ try to normalize its policy. You've had the ECB, of course, continuing to raise. You've had really a lot of tremendous amount of fiscal spending, as was mentioned, really unprecedented for non-war times. And so there are a lot of sort of things coming together. And one of them has been notably a rise in inflation expectations. expectations, right? So, which kind of underpins or emphasizes the somewhat academic nature of the CPI, in that your average consumer may actually have a different, or may feel that they're having a different experience, which can unmoor inflation expectations, and we've certainly seen them move up. And that also then contributes to how the Fed thinks about it. What do they do here? So there are a lot of factors that are coming together right now to push that long end of the curve higher, and I think that will continue to be a risk, and that steepening may continue to have some more legs from here.